Hello everyone, thank you so much for joining in today's video. I would like to go through an example to explain you exactly the effect of certain cost flow assumptions on financial statements. When I say on financial statements, I mean impact on ending inventory, cost of goods sold and gross profit. Under IFRS and US GAAP, we usually look at three cost flow methods. One is FIFO, first in, first out. The other one is LIFO, last in, first out. And the third one is a weighted average cost method. I will explain in another video exactly what is allowed under which accounting standard. Today I would like to focus on the mechanics, how it works in general from a technical perspective. Let's get started with an example. Let's assume we have a company that buys in each year 5 units. So it buys here 5 units, 5. So over the entire course, it buys 25 units of product. The unit price you can see here on the right hand side starts from 120, and then the unit price actually increases up to 280. So the unit price becomes more expensive, and then you see the total purchasing cost, which is 5 times 120, 560, and so on and so forth. So you see in total 25 units are sold, and the total cost is 5,000. That's the value of inventory. Another assumption is we assume the company does not sell all of the 25 units, it only sells 20 units in total. And another assumption is that the company has a selling price per unit of 300 over the entire 5-year period. So in every year, the company is able to sell each unit for $300. Okay, let's get started. Let's start with first in, first out. Let's look at cost of goods sold. Now let's start with revenue first. Let's start with revenue. Revenue over the entire lifetime is 20 units times 300 equals 6,000. Yeah, that's the total revenue. Let's look at cost of goods sold. Cost of goods sold. So what we have is first in, first out. So the product you buy first, you sell first. Means you are selling this product, you are selling this product, you are selling this product, you are selling this product. You are not selling this product. Yeah, because you bought this first in and then first out. This is the last product, so you go from here to here, and because you only need 20 products, you are not selling this product. Yeah, so what you do is to understand what you need to recognize in your income statement under cost of goods sold, you basically add up this price plus this, plus this, plus this, and again this one, not because this remains in inventory. So what you have is then 600 plus 800 plus 1,000 plus 1,200 equals 3,600. Yeah, 3,600. And then your gross profit equals 6,000 minus 3,600 equals 2,400. Yeah, 2,400 is your total sales revenue minus cost of sales or cost of goods sold equals to 2,400. Your ending inventory, would then be the remaining 5 units that you have not sold. They sit on your balance sheet with 1,400. Yeah, good. Let's look at last in, first out. Last in, first out. Similar procedure. Again, revenue equals 20 times 300. No change in assumption. You're making revenue or sales of 6,000. Then when we look at cost of goods sold or cost of sales, what we do is, again, we need 20 units, but the item that we bought last, we sell it first. So we need 20 units, so we are selling this unit, this unit, this unit, this unit, and don't do this. So we go the other way around. So our cost is then 1,400 plus 1,200 plus 1,000 plus 800. And if we add this up under last in, first out, you do the same. And then you add up with 4,400. Yeah, so this is when you add up 800, 2,000, 3,000, 4,400 here. And then your gross profit equals 6,000 minus 4,400. And this is 1,600. And then your ending inventory you can see, which is this one. Those very old units remain on your balance sheet. Your ending inventory is 600. Yeah. Let's do weighted average. Just call it WA. Weighted average. It's a bit different. So what we assume first, we need to calculate an average unit price, because here we don't really care what the change was in every year. We calculate an average unit price. We could do 120 plus 160 plus 200 plus 240 plus 280, and then divided by 1, 2, 3, 4, 5, because the unit, the amount or the quantity is the same in each year. What we could also do is gives the same result. We could use the total here divided by 25, gives the same result. So our average unit price is 200. Yeah, so this is over the entire 5 years. This is our average unit price. So what we are going to do is do the same. Revenue remains 20 times, because this is only driven by the selling price, which we have kept constant. Then you have cost of goods sold. And here, quite easy, you have 20 units times your average selling price of 200, because you're selling 200 units, 4,000. And again, as you know, in accounting, COGS, because you're selling 20 units, are recognized. The underlying cost of goods sold, the direct cost, are recognized when you sell your products, matching principle. So when you recognize and sell those 20 items, then you recognize 20. Here you are not looking at 25, because cost of goods sold are only recognized when you sell the product, and then revenue is recognized. Yeah. So then you have gross profit, 6 minus 4, so you have gross profit of 2,000, and your ending inventory Again, we don't need to look at single items. We are looking at our average price, which is 200, and we know we have not sold 5 units. So it's 5 times 200 equals 1000. Yeah, so that's the overview. What you see, because we have rising prices increase from 120 to 280. That's why first in, first out leads to the highest gross profit, because you use the older, cheaper inventory for cost of goods sold. LIFO, on the other hand, is the lowest gross profit, because you use for your cost of goods sold, you are recognizing your newer, more expensive inventory, which basically decrease your gross profit. From an inventory perspective, it is similar ending inventory, because your older product sits still on the balance sheet, which has a lower value, is recognized, and here your higher inventory value sits on the balance sheet. Weighted average is in the middle. If you look at your gross profit, is between 2.4 and 1.6, so it sits exactly in the middle. 2,000, and then the ending inventory amount also is between 1.4 and 600. Yeah, if the unit price decreases, then you would have the opposite effect. Yeah, so that's all I wanted to cover for today. Thank you so much for listening. Talk to you in another video. Thanks so much.